Well, thank you, Zoe, for the introduction, and thank you both to Aaron and Trish for being willing to be up on stage here with me today. And thank you to the Pork Producers Association for giving us the opportunity to speak today. And what I think would be a pretty good topic here and a very relevant topic in 2025, given kind of the uncertainty and some of the volatility that we face out there throughout the rest of the year here. So looking forward to that, and I think we've got a good one in store here and a very relevant one too. So just kind of provide a little bit of a history of our relationship. We started back in early 2018 working together. I think throughout the last almost 7 years, we've been able to kind of form a pretty dangerous tandem, or trio rather. I'd hope they'd agree with me on that. And really have faced a lot of volatility throughout the years. In 2018, with the trade war, 2019 ASF in China and what that did to the hog market, in 2020 obviously with COVID, and 21 and 22 kind of the an inflationary environment that we've been in. And what I think probably in 2024 was more of probably a stable year. So kind of the first maybe stable year that we've been in since we've been working together. So you guys have any items you'd like to share with the crowd on kind of our history at all, or?
I'll get into it in a little bit, I guess, or kind of as we move forward.
Okay. Yeah, so I think I'll hit on about 5 topics here today, and what I think probably makes a successful producer risk manager partnership, and kind of central to all that would be communication. The first topic is our consulting call that we have between each other. And then education, continued education on the call, as well as kind of outside the call time, as well as coming up with the risk management plan, reviewing and refining that risk management plan, and then utilizing tools during the call and outside the call to kind of help make our decision making more objective and perhaps a little bit more streamlined and more efficient overall. So the consulting call would really kind of look like a development of a website that will model and customize to the producer overall, and then kind of the continued maintenance of that website throughout time, whether it's updated quarterly, twice a year, or yearly. Certainly that's changed a lot in the last couple of years because of the inflationary environment that we've been in, cost of production raising to that extent, and kind of going from there. Using cost production as well as cash contract analysis and kind of the assumed basis of a producer to get a projected margin, and then basically kind of valuing that margin on a percentile basis over the last 10 years. So the consulting call between us typically is a weekly call. It's more of like a 10, 15-minute review kind of what is happening over the last week or so. And then kind of how the market's structured, our June hogs or July hogs, $10 over the index or $20 over the index. How bullish is the market, and what are those expectations going forward? And then we usually definitely focus on margins as well as margin percentiles, and and if margins are at a point where they like them, and looking at potentially protecting those margins, that conversation would evolve into a strategy discussion, which is that last point there. So this is a demo website for here at CIH. So this is just kind of a model here. So we have 44,442 head. We're going to market those pigs at 290 pounds. Use a 75.5% yield to get our carcass equivalent pounds. From there, we'll know how many contracts we need to offset, or how many contracts we need to offset that risk. And then below that, you have your cost production, so feed and non-feed costs. So corn would be 10 bushels a head that we're using there, 100 pounds of DDGs, and then meal at 90 pounds a head. Other feed ingredients, 60 pounds a head, and then at $30 a head for the other feed costs, and their non-feed costs, which we've kind of broken out into our pig cost, interest, and then other non-feed costs. And again, that gets our cost production that we use to measure the margins, on a quarterly basis or a contract basis rather. So kind of getting into some of the fundamentals that we're seeing here currently, and just kind of give a little bit more of a mock of what a consulting call would be. First we have hog slaughter. Hog slaughter last week was 2.63 million head, which is up about 0.4% year over year. Some estimates for this week are pretty light. I think we've got some disruptions going on here this week as far as weather goes, as well as some mechanical breakdowns. So we're actually looking about maybe 2.50 to 2.505 million head for hog slaughter, which is down a little over 7% year over year. And really over the last like 5 weeks, we've had probably an unfair apples to oranges comparison, given kind of the dislocation in holidays, as well as a year ago we had that red line is at 2024. We had a big winter storm that second week in January. So producer weights. This is the blue line. There is the 2025 producer weights. These are 5-day rolling averages of the 201 producer sold carcass weights. They've remained relatively stubbornly high, although they've come down more recently here, but currently at 10-year highs for producer weights. Pork production mostly kind of keeping up this past week with the hog slaughter, so came in at 571.7 million pounds. That's up about 0.4% year over year on pork production. And if you look at that red line, 2024, versus that orange line, 2023, throughout the month of late November through December, pork production had been running quite a bit lower than a year ago, which potentially could be offering a bit of support to cut out overall. Sow slaughter, you got that blue dot, which is the week of January 4th, so another holiday disrupted week. And sow slaughter kind of since early November time frame has been relatively elevated. A lot of talk out there of disease. This could be maybe further proof of how producers handle disease breaks, and maybe seeing the consequence of that with maybe elevated sow slaughter to a certain extent. Weaned pig prices, this is the last 15 years for weaned pigs, so we're in some pretty lofty territory here at the moment. This is really $2 away from 2014 levels for weaned pig prices. I think probably a few contributors to that. Obviously with disease out there this time of the year, decreasing the availability of weaned pigs. Also with cash and cutout where they've been and feed prior to the January Wall Street report, we had been looking at some pretty solid margins and maybe creating some good demand for those weaned pigs as well. This is taking the weaned pig price divided by the 6-month out future, so taking that weaned pig divided by the contract that would be marketed off of for the most part. And that dotted line is the average over the last 10 years. And for right now, for this time of the year, it's relatively expensive weaned pigs, for a 6-month out future. This is a little dated now at this point, but this is the November cold storage report. Currently came in at 10-year lows for the month of November. And I did a little bit more digging on that, and it's actually the lowest that pork in cold storage has been, since 1997. So we've got really low levels of pork in cold storage. For the most part this year, it's been very low levels, and the last I think that's the last 3 years, or last 3 months rather, it's been 10-year lows as well. So we will get an update on that come tomorrow. Just we'll get the December cold storage report on that. But on average, we tend to see cold storage from November to December relatively flat. I think you guys probably know where I'm going to be going with the export discussion, but the export sales for the month of November were at 10-year highs at 643.5 million pounds. So far year to date, that's up 4.7%. And a lot of the growth in exports over the last couple of years has been largely driven by increased Mexican demand. So this is the unfortunate part of the industry that we work in, and unfortunately one we have to deal with. And looking forward out into 2025, this is certainly kind of an uncertain time, going forward as far as trade goes. Seems like maybe the new administration has walked back some of their stances on, day one tariffs on Canada, Mexico, and China, and maybe even looking at that, by February 1st. But that is, definitely a bit concerning with Mexico, considering the growth in our exports has been, a lot of that has been Mexican demand the last couple of years. So this would be monthly export sales into Mexico throughout the past year. Not quite 10-year highs for November. Last year it was 10-year highs in the month of November. But obviously, for the most part this year, just extraordinary demand into Mexico overall. And then looking at Mexico pork exports as a percentage of our total exports, last few years we've been about 35% of our exports found their way into Mexico, versus prior to that in 2018 and 2020, that was more like 26% overall. So again, a lot of the growth in the export market, a lot of maybe becoming more reliant on Mexico pork exports as well. Currency could have a potential impact for trade going forward as well. These are a couple snippets here. You got the U.S. dollar against the peso. This is for yesterday values. So we got the peso against the U.S. dollar against the peso at 20.5. For the most part in 23 and 2024, the Mexican importers had a pretty nice advantage on U.S. product with a nice rate or a nice currency relationship, versus now that's probably more back to 2021 and 2022 levels. And then the U.S. dollar is also strengthened against basket of currencies too. So the U.S. dollar index not quite as high as what it was back in 2022 or late 22, early 23. But the dollar's been stronger, obviously there. So as far as global pork production goes, we'll kind of focus on 3 different countries in particular. So Brazil seems like they continue to expand. It's a lot, for the most part, it seems like it's a 1 to 2% growth each year. So from 22 to 23, they went from 4.35 million metric tons to 4.45 million metric tons. So it's up 2% year over year. And then looking forward, USDA published this back in August on their annual livestock report. They forecast in 2025 another 1% increase, reaching 4.65 million metric tons in Brazil. Seems as though Europe could be maybe potentially getting closer to stabilization. They were down from 22 to 20, or 22 to 23 by 6%. And going forward, according to the USDA's livestock report in September, their production was up in 2024, up 2%, but expected to decline 1.7% heading into 2025. And then China, seems like they're probably back to ASF levels according to the USDA. So we got growth from 22 to 23 of 5%, and getting kind of back to where they were back in 2017 and 2018. And they do, according to the USDA's livestock report, back in August, they're expecting pork production to decline in 2025 due to obviously fewer swine for slaughter and maybe weaker demand in China. This is the snippet from the January domestic balance sheet. So this came out January 11th, so a couple weeks ago, and I would say the corn market's definitely been very interesting. Post-report and prior to that, it had been interesting as well. Since September, the U.S. corn balance sheet's lost approximately 600 million bushels from where we were estimated for ending stocks back in September versus where we are now currently. So now we sit at 1.54 after a 3.8 bushel yield cut on that balance sheet. And then looking at globally, major exporters, right now ending stocks for major exporters are currently at their lowest levels since 2011, 2012. So going forward, certainly less room for error globally and less room for error domestically to kind of keep ending stocks in a reasonable area. Going back to that last slide, ending stocks are really about 180 million bushel away from where we were back in 2021, 2022. So kind of second part of our consulting call would kind of generally be like, market structure. So what is the lean hog index versus July lean hog futures? So as of yesterday, late in the day, there is about a $19.20 premium on July lean hogs over the current lean hog index nearby. So the market is expecting the lean hog index to rally, $19 between now and the middle of July, which is about average, for this time of year for where the market would be trading at versus the index. Cash hog market, one thing kind of sticks out to me on this chart. Obviously, January, February last year, in 2024 were pretty poor times, but we kind of came out of that, quick, fast, and in a hurry. But the cash market has been relatively stable, since March, April timeframe, kind of right around that 80 to 85 area for the most part, and it's had kind of a slow go of it, as of late too, since early to middle of December, prior to some of the holidays here. So. A little bit of a slower start to the year on cash hogs, but seasonally we maybe do tend to see some strength in cash going forward. And I'd say the same kind of rings true for cutout too. It's kind of got that same stable look to it. It's been mostly range bound the last year, $90 at the low end to maybe 105 at the top end. And some of those extreme rallies, back in 2021, 2022. We were able to get to 115, 120 summer hogs. We had some pretty strong cutout, 120 areas, even one brief time there at 130 versus last year was just really stable, and so far this year it's been pretty stable as well. So after that, we kind of get a little bit more into margins. This would be our fourth quarter 2025 margin stacked graph. So this is from a demo website, so everything's anonymized. But currently right now, fourth quarter 2025 margins are at their highest level in the last 10 years for this time of the year. And one thing kind of sticks out to me the most on this chart here, if you look over towards the right, when we get close to expiration in December, we obviously had a blowout quarter, Q4 of 2024. And hopefully that repeats again this year. But the last previous 9 years before 2024, we had finished out at below break even or below zero there by the right-hand side there. So good opportunities currently. Core markets rallied quite a bit over the last few months. And more recently, deferred hog futures have kind of picked up some of the slack to offset some of the increase in corn price. Fourth quarter is seasonal, so we tend to be kind of on the upward trajectory here over the last 10 years. Seasonally, we tend to find a high kind of in that mid-April to late April time frame, but we are at good levels here currently, so it's kind of a balancing act, right? We have good margins here currently. Seasonally, we tend to go up. So if we're looking at maybe some coverage, it could be something where we're looking at a percentage of production and maybe keeping upside open. Aaron, Trish, kind of how does seasonals play a role in some of your marketings?
Yeah, I think it's always, for us, it helps kind of bring us back to center if we're maybe biased a certain way, and then, some of the other things you went through, but seasonals and some of those stack graphs are two things that it's like, all right, maybe things aren't as bad, or maybe it is reasonable to think it's time to start getting some floors put in and those kinds of things.
Yeah, one other thing I like about the seasonals, and you can see on there, they've got the 10 years. This is a 10-year look, but I always click off 2020, and if it's a longer one, 2014, because I don't want those years to skew maybe what has gone on in the past.
Yep. And we were able to kind of take those out as well, and it does kind of maybe push the season a little bit forward if you take 2020 out overall, and kind of got the culmination of seasonals where we tend to be kind of in March time frame where we have all this disease talk, current and in the past, and we also have the seasonal upward tendency for cash and cutout too, and kind of culmination of all that kind of provides a good opportunity.
Yeah, I would say also with the seasonal, sometimes maybe if we haven't got as much coverage on as what we should, it's sometimes a good reminder we need to maybe increase what we're doing or maybe get after a little more. Mm-hmm.
So kind of looking at fourth quarter, in particular, looking at the hog crush in general, what makes that 91st percentile? What's a combination of corn being at the 67th percentile in the last 10 years, meal being relatively average levels at 54th percentile, and hogs are at the 75th percentile. So getting all three of those together, we'd be at the 91st percentile in the last 10 years. The last 10-year high, if you can see that, the highest $20.61 in the last 10 years. So once we kind of get to those 90th percentile targets, to get to even higher levels, it takes more of an increase or more of a dramatic increase in margins to get to those really, really good times in the last 10 years. But also on the flip side of that too, the 10-year low there at -24, we definitely want to try our best to avoid those scenarios. So the next 12 months, what does that look like? So second quarter of 2025 through Q1 of 26. So the next 12 months of margins here would be currently projected to be $10 a hundredweight, which is a 10-year high for this time of the year. So not only looking at fourth quarter, which we just kind of looked at in isolation, but Q2 and Q3 also look pretty good as well going forward too. So we wouldn't definitely not sleep on those quarters as they've been pretty good too, and good levels for next 12 months. So if margins eventually got to the point where we're looking at protecting those levels, a couple of different strategies that we'd be maybe looking at. One could be outright LRP or LRP with a short call. LRP, this is a D16th end date, so this was Tuesday offerings and Wednesday morning offerings at 76.01 coverage price. The cost on the LRP was $497. Obviously could just do that and kind of keep the upside open in light of that seasonal pointing higher into that March-April time frame. But if we're looking at trying to bring in some premium, one thing we might be able to look at there is selling calls. So you could sell an 84 call for $2.30 a hundredweight against that to bring the cost a bit lower. And then this is kind of looking at that LRP as well. So this would be the LRP versus board estimate on the top of that graph there, and then the projection differential of that. And what kind of creates that value is the subsidy. So the LRP versus board estimate would just be the cost of the LRP versus what exchange traded put would cost you for that same date and same coverage price. And then the projection differential is simply just the coverage price minus what the CME projection would be, and that CME projection would be at the very bottom there, and that's that blue line. So basically taking the futures market, plotted out over the next 12 months, and then taking the Link Hog Index and what it seasonally or historically tends to do around futures markets. So looking forward here in the next week or two, on average, last 10 years, we tend to see maybe a little bit of weakness in the index in the next couple of weeks. So potentially, could be a decent opportunity there to maybe have some floors in late December, early January, kind of around the holidays. This would be kind of the strategy discussion here. So LRP short call versus futures long call. This is what these two positions look like here today. So if we get to $90 or $60, which you can't do due to limits, but these are two strategies that are relatively similar cost. Looking at them, on right next to each other. So similar cost, but completely different profiles to these positions. So the LRP short call for 255, they both have similar deltas at the current market. However, their delta changes a lot in a higher market. So the LRP short call on the left there, that delta is going to increase in a higher market. So it's going to act as if you're getting more and more short versus the futures long call, that delta is going to decline in a higher market. So the futures long call, having that delta that declines in a higher market might fit a bias that's more bullish, or it looks better if we see a market that really explodes up in a short term. I think you guys have liked using the risk manager quite a bit. I mean, what types of positions do you like using, or what I would say, what time of the year does your strategy selection differ throughout the year?
Yeah, I think the risk manager allows us to get on there and look at the way the market is today and what happens if this happens, if over time, or if the price goes up or down. And I think for me that's been helpful because farmers generally are remorseful sellers. I'm always like, you make one sale and you start rooting against yourself. And I think the risk managers helped me to be like, all right, well, even if the price isn't where we want it to be, then I can look at what adjustments we might be able to make and still be able to get some coverage on if that makes any sense. But it's helped me to go ahead and start getting positions on, even though it may not be the exact price that I think it is going to. And generally I'm too optimistic anyway. So, but anyway, I would say that's probably one of the things I use the most on the website is the risk manager.
Yeah, I look at LRP a lot. And again, kind of the interesting thing is we don't always look at things the same way, but yet we have the same farm. So that always makes for some interesting conversations that Eli sometimes has to just sit back and listen to us as we talk on our call.
He's more of like a referee at times.
Sometimes a referee. So I think that's good that we kind of don't attack things from the same angle. Our brains don't work quite the same. But so Eli does a good job of explaining things. And I would say what probably drew us to kind of be more disciplined and join CIH and have our weekly call is that we were just tired of fourth quarter kicking our butts. And we just needed to do some work to make sure that we could put what we thought at any point, if we could put a floor in there or some type of coverage, because you hate to make money in the summer and then give it all away back in the fourth quarter. So there's just a lot of tools. LRP is one of them that we utilize a lot of with short calls to go along with that. So their data is great. And again, when I look at LRP, then I'll pull up a chart that looks at the index for that historical index, so I can look at a range, I can look at what's an average price for that time. So I feel like, am I getting a value in a way that the price is something that I would be happy with an over 10-year time frame average? And again, that's when I talk about 2020 was such a horrible year with COVID. I usually pull that out because I don't want to have that skewing what kind of an average price that I think we could get with an LRP.
I would say one thing too about looking at this page, you can take and move the price. So if the price is here today, what if it goes to here? I think that's been important for us to do too, especially when you look at the one that's on the left with selling a call. It's great in the sense that it can lower the cost of your LRP, but you have to be prepared. Even though you want the market to go up, you need to be prepared if it does go up. You may have some margin to spend, and it's still good because the market went up, but it makes you prepared for what that position can do, potentially.
Yeah, I mean, a big difference in these two positions and how they look at, how they look today versus how they look at expiration. So, LRP short calls, just floor at 76 down to 0, and your upside's all the way up to 84 minus the cost of the position. Versus the futures long call might look good in the short term if we see a nice rally. In the long term, your upside isn't open until 84 at expiration. So December, I think in the last 10 years, 2024 was just below $84 at expiration, and then 2022 we were just above $82 at expiration too. So historically speaking, I'd probably like to have my upside up to 84 as opposed to being open at 84, but that might vary from producer to producer. And and these definitely have much different look to them at expiration versus what they look like today. I think it's kind of a nice segue into kind of the education aspect. So after the consulting call, second point, we have education. So education, I think, is probably threefold for us. What happens or what transpires on a consulting call. So if margins are really good and we're discussing a strategy, having that constructive conversation on what strategy makes the most sense for any given time. And then also what's offered outside of the call time too. So like our margin management seminars, strategic position management seminars, looking at kind of what occurs maybe more during the call and also with those seminars too. But what we have here is different types of positions that a producer might implement to protect against their inputs on the left there, or the revenue side on the right hand side. And then when the market is really bearish, for like your corn on the left hand side, buying a call spread might make the most sense. Kind of keep the downside open rather. The market's really bearish on the revenue side. On the right hand side, it might make more sense to sell futures or buy a put and sell a call. As far as exchange traded positions go, so that's does not have a short put below it. Producers also have livestock risk protection, livestock gross margin at their disposal to use. Over the last few years, LRP's utilization has definitely kind of taken off. With the improvements that the USDA RMA has made over the past couple of years with it. So just kind of a broad overview of what livestock risk protection is. It's a program to ensure producers against declining market prices. Producers can choose different price levels for time periods ranging from 13 to 52 weeks Producers are able to go out to 52 weeks if they have insurable interest on sows. And then the subsidy premium, so subsidy is based on coverage levels, and it ranges from 35 to 55% subsidy. 35% subsidy for more at-the-money coverage versus 55% for further out-of-the-money coverage. And then a premium will be paid at the end of the contract and based on the coverage price and rate from RMA. So that's much more cash flow friendly compared to what it was, 5-6 years ago. So after producers actually sell the hogs, then a premium is due versus with the exchange traded put, in the brokerage account. You'd be paying that money up front for it. So there's a bit of a difference there from a cash flow standpoint. Indemnity payments, pretty easy there. Indemnity would be paid if the coverage price is above the actual end price, the CME index. In other words, the CME index settles against the LRP for the day after the end date. And then coverage prices and rates. The prices and rates are released in the afternoons by RMA. Most times they come out daily. There's some days where the market's down limit or up limit that the RMA has the right to kind of withhold that, or hogs and pigs report days or holidays. And then producers have the opportunity to buy LRP up until 8:25 Central Time, for the day after when they're offered. A couple different recent changes they've made this past crop year. I'd like to kind of focus on the second and third bullet point. So they increased head limits to 70,000 head per endorsement and 750,000 head per crop year. And they also modified the insurable livestock that had sold within 60 days before and after that end date. So there's a wide runway for producers to use actual kill sheets or marketings as proof of marketings against the LRP endorsement. LGM was first introduced in 2003, insures producers against declines in future gross margin. It's offered every Thursday, and then also it's up to 6 months out. So the big difference here between, or one of the bigger differences between LRP and LGM is this LGM goes out to 6 months versus LRP you're able to go out to 52 weeks or a year if you have insurable interest in sows. And then it's used, calculated using a standardized crush formula every Thursday. Using applicable hog, corn, and meal contracts. And then the last two bullet points, the indemnity to be paid, if your protected margin value is greater than the actual settlement margin value, and vice versa. One item here is the Gut to Hog Margin Management Seminar. We have yet to put one on the calendar yet for this next year. But a couple different topics that are covered. This is kind of more level 1 class that producers have access to. So basically some of the topics there would be introduction to futures markets, introduction to options, basically kind of a level 1 introduction to futures and options, different core strategies that you might use for the input side or the revenue side, and then the best practices with the position management, plan concepts learned. And then our education team gets to go to Tempe, Arizona here in about a month. So so this one is the more advanced level. It's the second level one. It's basically identifying triggers for strategic position changes, as well as managing volatility for multiple inputs, as well as the revenue side, weighing risk exposure for those position alternatives, and then emulating position and management best practices. So this tends to focus more on the Greeks of options, more on delta, the change of the position value versus the underlying futures, and then volatility. So if volatility is high, what position makes the most sense based on that? If volatility is low, what makes the best, makes the most sense in that type of environment. You guys have been to a couple, I think, 2 in Okoboji, 1 in Ames, and then Aaron, you just went to the SPM in Okoboji.
Yep. Yeah, and just on the topic of education, I go back to when we started, and we started off going to a seminar, and with the goal, like Trish said, of, we knew we were not happy with, a lot of fourth quarters, and like, we got to change what we're doing, and we can't just give all that up. And so that's what got us there. And then as time went on, I think farmers are a little intimidated on some of the terminology, and you don't want to, let people know that you don't understand something. And so I think we're a little guarded that way. But, I think we started off, especially in our calls, just learning the terminology and learning all right, this is what this does, and then as time goes on, it's almost kind of like I liken it to a foreign language. It's like once you stop translating in your head, you're starting to have a better grasp of what the tools are. And then I think as our relationship has progressed and we've maybe gotten a little more comfortable, sometimes we'll even do a position maybe that we haven't done before. We're like, well, let's just try this a little bit to see how it works. Because for us, to really understand how a position works, it's almost like we have to have something going, wouldn't you agree? And we just follow it closer. And so I think that's kind of how our education part of this has evolved. And it's kind of, we still have a lot to learn and a lot of things that I wish sometimes I get frustrated, especially talking about Delta and some of how positions are affected. But I do think our weekly calls kind of keep us going. You know, if we just did calls as needed, I think we wouldn't be as sharp as what we need to be. And I'm not saying we are yet, but it's definitely helpful.
Yeah, when we started, I had not really had any classes in college or anything about features and options, and so I was very green. I was very clean slate. Like, I needed all the education, and I appreciated the time that our first consulting calls, we would spend so much time on education each time, as well as the website has a lot of modules you can go on your own and do at your own pace if you want to get more. So I think, you know, as we talk to people in our community, you know, because we have a lot of pig farmers, and it is kind of intimidating to, like, I didn't know the lingo, and I wasn't afraid to admit I didn't know the lingo, but some people don't want to do that. So I think it's a very great way to just start and build with the knowledge of what the terms are. And like you talked about, like, it's like a foreign language, you have to translate it for a while.
And I think
I mean, a long while for me.
Well, and I think Eli would probably agree. There'd be times, I'm sure, we'd get off our call, and I was like, I bet he thinks we've got to be the two dumbest people that he's ever dealt with. But I would say, I think what made our relationship work is he was patient, and he knew when things were going well and we were picking things up, and he kind of knew when he needed to circle back and kind of maybe hit it again. So.
Yeah, I think that's the biggest thing. I mean, you know, before a producer adds a position, and I mean, it's one of the best ways to learn is to actually have a position on, but I mean, prior to that, kind of providing a base of knowledge prior to, you know, a producer putting a position on, so at least to kind of have a broad sense of what to expect, you know, given the kind of the market change throughout time. So.
And I would add too, like, you know, we went to our first seminar before we'd started with CIH, and then it was quite a few years before we went to another one, and I think we kind of just got to the point, it was kind of looking forward to maybe having a jump start of, you know, let's talk about some new things and be around some other producers and see what they're doing. And I think the last one that I came away from, the main point was that, you know, position doesn't have to be a permanent thing. Like, just because you take a position on something doesn't mean that is over. So if we're talking about December of this year, you know, you can adjust. If the market goes down, maybe you have a position that you can make an adjustment. And I think that for those of us who are remorseful sellers, and I am one, it helps stay on track and not kind of let some of these things live rent-free in your brain. But
The seminars, yeah, like I said, we went to the first one before we became clients in whatever year that was in Ames. And it's really nice because it does start with just like the basic building blocks of what you have to do to understand, and then you work through, can become simulations. Is that what we go through? Is that what you call them? Yeah.
Yep.
So then you're like given a scenario and what would you do, and you have your computers and you're on the website and doing the thing. So it's a great practice for just really what we do every day.
Yeah, that end of the first day, second day on those seminars are really engaging, where you're kind of given more hands-on, you know, with those tablets there, and kind of make decisions and kind of reflect on it afterwards.
well, and I guess I would add too, you know, if you're not doing margin management as such as like what we're talking about today, I would encourage, if you have an opportunity, to go to a seminar. And I think it's, even if that's not the route you go, I know it was helpful, and I've known others that have gone to them and be like, oh, it was just good to kind of see what the other side of that might look like, and if parts of it could be beneficial. But
So the third point here, they're coming up with a risk management plan. So, you know, when margins are good, you know, having a game plan in place to kind of, you know, take advantage of that. So, you know, designing the margin management plan, you know, to customize the client's needs and their bias, you know, their access to capital, you know, how friendly they are, you know, what risks they can take on versus what they can't. And then identifying opportunities, you know, that'd be margin driven and more seasonally driven. So we got those two aspects of that. Implementing the margin management plan. Actually adding alerts so it's ready to go when good times are there. So this is just kind of a mock of the our demo site here. I don't know if you can see that, and I apologize for that at the very bottom there. But 1 year out in time, margin percentiles of the 70th, 80th, 90th, 95th percentile, maybe adding tranches of coverage at those levels. And then we're above or outside of 12 months, maybe kind of waiting for better levels, given you have more time at the 80th, 90th, and 95th margin percentile. This is just kind of what the margin management plan may look like. So this is Q2 through Q2 of 2026, and then you have your margin percentiles on the left-hand side. This specific plan here maxes out in total coverage of 65%. So that's kind of what I mean, customize the client's needs or bias. They might be comfortable getting up to 65% covered and kind of keeping the rest open. And then those are the respective margins at those current levels. So hitting that green box there enables an alert, and it triggers a conversation between a producer and myself, or a producer and a risk manager to kind of have that conversation to kind of discuss strategy on how to protect that. And finally, we have the execution of the margin management plan. If you're at good levels there. So after that, quarter's end or a contract ends, or maybe it's twice a year, reviewing and refining that process, I think has a lot of value and benefit. What you could have done better. Hindsight's always going to be 2020 when you're reviewing a position, but I think it's kind of good to go back and actually reflect how you did. And there's a couple tools that we have to can look at that. So this would be their LRP endorsement trade allocation tool. So this is it's not an actual endorsement that we did. It's mock. It's on our demo website. But we did this position as a January 3rd LRP, 77.34 coverage price. We sold these calls against it for $3. And then we exited those calls at 85 cents after the market had pulled back into June timeframe. And then we also sold Feb calls against it, and then market rallied from June into October, and eventually flipped that position into futures at 85.37. And then a few weeks ago, we actually bought back those futures and realized some profit out of them. So when it was all said and done, our fake LRP endorsement did not yield indemnity, but given kind of what we were able to do and manage over the last year or so and try to reduce some of the premium in that LRP, we were actually able to offset about 455 a hundredweight of that 528 hundredweight. So ultimately we did lose a little bit on that, but the longer positions in place, there's more of a chance to maybe kind of make some tweaks to it. This is our position history for Feb. I'll just kind of gloss over this here real quick. Open market margins, the red line, the net line would be the blue line, and this is using an assumed basis. And then we have, so basically back in July, you can kind of see the red line dipped quite a bit more relative to our blue line, so that would be our position, offsetting some of that, dip down. And then after that, after July, August time frame, Feb obviously flipped the switch and had a nice V-shaped recovery to it. And by October, November time frame, our delta, which is that green row there, pretty much maxed out. So we got to a point where, hey, prices are at a really good level. Let's take all the risk off the table and max the position out. And markets pulled back a little bit lately, and we made some adjustments, as that prior slide showed there on the LRP endorsement manager. And then finally, we kind of have the utilization of important tools. So using technology to kind of make decisions a little bit easier. I don't know if we have any lenders in the room or not, but this is a good tool for producers to use in conjunction with their lender. This would be a 10% positive move in margins, and kind of given the industry or the hedging in nature, either we're always too sold or not sold enough. So in a case where we have positions on, we're too sold, and margins keep getting better. We're pushing corn up, hogs down, and meal up. The performance bond on the change row there, that's basically saying how much funds we would need to maintain that position while the open market margin, that person has perfect clarity and knows where the market's going to go, so they benefit by the full $6.9 million. And then the net margin is a change, so their position that we have on versus what the market did, we're able to benefit, $3.08 million of that $6.9 million move in margins. And in case we're not sold enough, margins deteriorate, that is saying that we would have access, or our positions would generate about $3.7 to $3.8 million. So open market margins, again, deteriorated by that $6.9 million. We're able to offset about, $3.1 million of that. So with increased utilization of LRP, actually putting a value to these endorsements at any point in time. So with the market moving around, we're able to kind of look back and look at, hey, how much premium do we have due versus where the market's at? And this is a little dated, but this is a June 30th eval date for 2023. At that time, the demo website maybe had some October endorsements on, some Ds in Jan and April. So those are all LRPs that would be forward-looking at that point in time for that eval date in June. So we'd have about $1.15 million of premium on the LRP versus our LRPs would be expected to or estimated to have an indemnity of about $312,000 there. So they might value that as a bit of a liability on the books to the tune of about $840,000. And then we do have dashboards, so as Aaron and Trish know, they're seasoned veterans of the website by now. There's lots of nooks and crannies of the website, lots of information on it. So when you get to a certain area that you like, you're able to kind of pin those to dashboards and make it more of a one-stop shop. It could be fundamental based, it could be margin seasonals, it could be corn seasonals, anything, and kind of make it a bit easier to kind of track and follow. So in summary, what makes an effective producer risk manager relationship? Let's say continuous updates between the two of us or three of us, the risk manager and producer, creating a risk management plan, and also the implementation of it and just kind of sticking to it. Education of available tools to offset your risk, whether it's exchange traded products, LRP, LGM. Those are a few different tools that producers are able to use. Using technology to make your decisions more objective and more efficient. Those could be seasonal tools there. Could be the capital monitor, kind of put things into perspective a bit more. And then for 2025, going forward, maybe looking at locking in some of the profit or some of those margins that are out there, while keeping maybe some upside open, kind of a tip of the cap to some of the disease chatter out there, and cold storage being low and exports being relatively strong. And certainly there's potential out there, I think, but margins are also at a good level as well here in the short term. So with that being said, I think I'd like to open up the room is there any questions at all for anyone?
Yeah, if you guys have questions, I can pass around the mic. And yeah, we have, 10 minutes of this, but we have all the time. We'll keep them here as long as we can, right?
So one thing we didn't talk about a lot, but the CH is also able to help us model when we were talking with packers when our contracts were up, like what's out there, what's available, and Eli was able to help us model, whatever formula the packer would give us, so you could compare a cutout contract versus an index contract or a cash contract. And so we've got a part on our website where we've got 2 different contracts with packers, and we can always look to see where they're at. And I know historically it doesn't necessarily always mean anything, but we can go back over time to see what that contract has performed in the past, and then every day we can see exactly what that contract is current.
That was really helpful.
Yeah.
And it's not something that you may only deal with that every 4 years, as far as when you're doing something new, or however many years. But yeah, that was something that we didn't talk about that helped us a lot when that time came up for us. Are you talking about like Trish and I opposing views? Yeah, I would say it is. Trish said before, we don't always look at things the same. I would say, though, we have similar levels of what we're risk as
Risk
far as
tolerance,
positions.
yeah.
Yeah, like we're more of I'd say we're more insurance based. Like we do a lot of LRP. We're comfortable with that cost of insurance, and then kind of what we maybe sometimes don't agree on is, you know, should we sell something above to try to cheapen that up? And sometimes it's like you may be just happy with the cost of that insurance, and I may be like, well, we might as well get some of that back, you know. And that's just an example. That's not necessarily how we always are, but yeah, I think anytime you have more back and forth and different ideas are good. So
Yeah.
it's kind of interesting sometimes, like if one of us can't be on the call, and then you come back and like, oh, by the way, I did this and this and this, and you know, sometimes that's okay and sometimes it's not, but
It's always okay.
it's always okay. But it is kind of funny how we do handle the calls differently when if it's just one of us is on. I think it is, when you say it's
Yeah.
different, but.
Yeah, like I said, you can only go into the depth so much of what is available on their website, but I tell you, if there's any metric has to do with swine, you can graph it, you can track it, you can go back 15 years basically with what. So if that's something that's interesting to you, because before we had this, I'm like, well, how do I go find the history of whatever the CME index was, you know, and that's a lot harder. So I would say that's a really big advantage, that the tools, that the access to data is amazing.
Well, and when going back to what our calls look like, you know, when we start off the call and go through fundamentals, you know, we have the website in front of us. Eli walks us through, let's look at this. And some of those slides, you know, we don't maybe go through all those every week, or we might go through different ones, but let's talk about the fundamentals. We can form our own bias, but, you know, make decisions off actual information of what's going on. And I think as farmers, sometimes we convince ourselves things are a different shade than what they are. And I think Eli's always done a good job of not telling us, well, this is what it's going to do, or this, but here's what the fundamentals are telling us. What do you think you need to do to protect and move forward?
And those worksheets that, you know, have the crush on them with the corn and the meal and the hog prices, obviously every day we want to buy the lowest soybean meal, buy the lowest corn, and sell for the most price. But you're never going to have all those on one day. So that chart gives a really nice visual of where you are percentage-wise, and the real answer is where's your margin at on that, not just one of those other pieces. So
it is kind of funny when you look at those margins, and we saw some that are in the 90%. We've got some opportunities to be in. But when the open margin is 70%, you're like, boy, if I could just get to 75, I'd really start going. And then it's just human nature. It blows by that. And I think with having our worksheet and having our weekly calls, it takes a lot of that noise and emotion out of it. And which I think the one thing we are different on is I'm more of an emotional seller, buyer, whatever. Where Tricia's, I think, more. All right, if this was a good sale, this was a good position, let's move on to the next one. And so I think kind of a combination of all those things it's definitely improved what we were doing prior to, before we were just, I don't know, kind of.
Using emotions more than anything
Yeah,
to do our marketing, which, sometimes that works, sometimes it doesn't.
Yeah.
Well, I know you guys kind of talked on, what the benefit was for you. If you've had, and you've kind of starting to close it, but if there's any closing things that you say of, encouraging others to, start this relationship or partnership, with someone like an account executive with CIH or anything, what's the biggest benefit or takeaway that you guys have?
Well, I would just say don't be intimidated or feel like you don't want to expose yourself, that you don't know, oh my gosh, I don't know what short call is, or that's I just think it's producers have so many things going on. You have to be an expert on so many different things. I think don't be afraid to go to a meeting, talk with other producers, and you don't learn it all in one day. And like I said, I feel like we're just getting started, but I know we're a lot better off than where we were, and just continue to learn.
Yeah, I think the other thing is it's always nice to be able to have someone we can just give a call to, like, something happened in the market or something happened in the news, like, what do you think, or what do you, it's just nice to have another person outside of our farm to have that conversation with.
And if you're a livestock producer that also has crops, you get combine fever, and the last thing you want to do is you don't want to have a call. All you want to do is think about that. And I think it's just a good reminder that you can't take those breaks. You have to, maybe your calls look a little different in the fall and the spring, but you still need to be focused on, because it's such a big part of our success now. I mean, and that's going to continue to get more important. The job that we do protecting margins, it's just not an option to not, I think, have some kind of plan.
Awesome. Well, let's give them a round of applause and say that we appreciate your guys' time so much. So, with that, you guys are welcome to wander back up to the trade show and spend the afternoon there. But I really appreciate you guys coming out today and the support that you guys have had for Iowa Pork and Pork Congress especially. So this event is for you guys, and so anything that we can do, let us know.